everyone. This is Rob Roy, and welcome to the Elliott Wave Options U.S. Market Update. Well, the big news today was that there was a G7 meeting this morning, a phone call meeting of the central bankers from the G7 countries. Everybody knew that was going to happen, and apparently the Federal Reserve was upset that that leaked out, which I'll tell you about in a second. But the results of the phone call was really nothing. They said that they stand ready, but there was no actual monetary policy changes announced. The market, a lot of people think the rally that occurred yesterday had to do with anticipation of this call this morning and the fact that there'd be a coordinated easing. Well, they came back again and said they stand ready, but nothing was announced. Market sold off, futures went down, market opened to the downside. And then about 30 minutes into the trading session, the Federal Reserve announces a surprise 50 basis point rate cut. There had been some speculation that they might wait till the March meeting, but they decided they'd go ahead and do it. And then they came out afterwards and said that the reason that they did it this way, one, they were disappointed that the news of the G7 meeting, phone meeting, had leaked out. They actually wanted that to be a surprise. And so when that made its way around, they decided to make the 50 basis point rate cut a surprise and not announce it after the phone call. It's one of the more bizarre things that I've heard. I just can think that Alan Greenspan must just be shaking his head, because this is not the Alan Greenspan Federal Reserve. In fact, it seems almost like the patients are running the asylum here with the Federal Reserve. But the market rallied off of that. It seemed to have the desired effect, and then we just sold off pretty much the rest of the day. Second big thing that happened today, I'll tell you about when we look at the charts. So let's take a look. So the last time I talked to you, I said that we were expecting a bounce off of the lows, and that's exactly what happened over the past couple of days. Yesterday, the big move higher with, I think, the expectation of monetary policy easing from the G7 central banks. And the other piece of it was, if you've heard me do these recordings, you know what it is. What's the rule that I state over and over and over again? No security in any time frame gets very far away from its 10-day moving average. So really this bounce was a pretty easy move, and we had taken all our puts off, I mentioned to you in the last recording, and we're looking for this bounce, and we got it today, and so we took the longs off today as well. In fact, are looking for a move back down. We timed it perfectly. We added some puts right when the market hit that 10-day moving average. That's when we took the calls off, added the puts, moving to the downside here, and that was the easy part. Coming back to the 10-day moving average. Now we get a little more convoluted movements. I think we're going to have the backing and filling where we'll test higher, we'll test lower, and actually that would be a good thing to see is some back and forth here and start to build a base. The question is, at what level is the base going to be built? Is it going to be right in here, a little higher, a little lower? I wouldn't be surprised at all to see us come down here to the beginning of that entire wave 5. That would be a pretty good Elliott wave support from the big move to the upside, but we also have this support right in here that we've talked about, which is the 61.8% the retracement level that we detailed in the last recording. So all that stuff is in play as far as where we find the bottom. Just don't think we're going to run right back to the upside. I don't see that part in the cards, especially when the second thing that I wanted to show you occurred, which is interest rates. For the first time ever, so we're getting some things that have never happened before in the market, but for the first time ever, the yield on the 10-year went below 1%. Never happened before. And then you can see this bar here. Now this is the 20-year, so it's kind of a hybrid between the 10 and the 30. It's also very liquid, TBT. But you can see we have a big outside day here, meaning that the low of the day exceeded the low of yesterday, and the high of the day exceeded the high of yesterday. So that's a big outside day. And sometimes when you see that, it represents a change of direction. Certainly uncertainty, but not quite like a doji, but quite often it can be a change of direction. Maybe interest rates start to go back to the upside from here, which would be nice because, as we said, breaking below that level around 23 went past the area where rates are positive and good for the markets and foreign companies, to the point where it's showing economic weakness currently and on the horizon. So we'll see if that creates any sort of a bounce back to the upside from that move, especially breaking the 1% level. You would think that we might get a snapback the other way. That would actually make some sense. If you're long the market, or if you want to be long the market, one positive that you can take into this is at some point in time, once this fear subsides, and let's look at the VIX while I'm talking about fear, because it's still very elevated, huge intraday swings here. When the market rallied, the VIX came way down, and then as we sold off the rest of the day, the VIX moved back to the upside. But big, massive bar here. But trading in level of just under 37 is still pretty high as far as the VIX, so we can expect some more volatility, at least for the foreseeable future, next couple of days anyway. Whenever the fear starts to subside and we start to build that basing in, you can make a pretty good case for the fact that we're likely to move back to the upside at some point, because where else are you going to put your money? You're going to put it in stuff yielding less than 1% or right at 1% to tie up your money for 10 years? I mean, already part of the reason I believe, and a lot of pundits have talked about this as well, the stock market's moved up because it's the best game in town. We looked at the high yield chart. I mean, people actually taking additional risk, which I didn't think that was a good idea, but putting money in things trying to get a better return than what you can get out of bonds and treasuries now makes a lot of sense. So that could be a reason for a movement back to the upside sooner rather than later. But again, backing and filling first. So we'll test probably to the upside and the downside. We'll find some footing over time, and then likely start to move back to the upside, provided things don't get progressively worse or worse than what's already feared with the virus. And it does spread pretty quickly. Even though I know the numbers, it's not as bad as influenza yet. A lot of people keep talking about that, but this one really spreads. So last thing I wanted to show you was the dollar, and you can see that the dollar has come down, and this Elliott wave pattern to the upside here has now been disqualified with a wave 4 retracement at 82%. So that's disqualified. That means the dollar will be coming back down here and erase that impulse move. Now that's a positive for the markets themselves, the equity markets as well. We get the dollar back down. This isn't really the way the people would have wanted it, economists would have wanted it, or the government would have wanted it to come back to the downside, but at least it is back down, and that will help moving forward too. So we have some factors in that you can visualize down the road, giving us a little bit of support to move back to the upside. I did want to show you one other thing. I said the last thing, but one last thing here is I wanted to show you volume. Volume was elevated yesterday with the rally, but lower than the previous 2 days and lower than today. So still having more volume on the down days. A lot of people thought that, well, volumes were lower today, but they picked up quite a bit towards the close. And as we sold off into the close, the volumes picked up quite a bit. So it ended up being a lot more volume today than yesterday. So that doesn't show quite the washout yet. And maybe that's what we need. Maybe we need one more big spike in the VIX, another spike down in the markets, and that washes out the shorts. Or maybe we just start the backing and filling now. But that is going to occur. And I'll be back to talk to you about it. Take care, everybody.